Shreyash Devalkar is with us of Axis Mutual Fund. Shreyash, good morning. Great to have you back on the program with us. Appreciate it. Let's just hope now that the ceasefire stands and it's a bit of a clearing event for markets, and we can look at other things now. So, what are the other things which the market is going to focus on? Does the market need to readjust at all, or I mean this 200, 250 odd point move that we have today? That's it. I mean, we didn't see any large risk off on the back of the conflict in the first place to begin with. What's your sense?
Yeah, so that Raj risk off was definitely was not there in the market, and in that context, definitely when it comes to its internal sector rotations, so we have seen some correction in actually a little bit correction in the stocks which are crude oil price sensitive, and those stocks actually have seen some reversal after that. At the same time, overall from here on, if we want to look at what next, then definitely this overhang of geopolitical issue, whether with this development, whether it is over, and we should move on with the domestic as well as other export oriented parameters. So if we try to move on with that, few parameters are there. Definitely, we have seen rate cuts. We are seeing now crude oil prices coming down, and its impact on overall credit growth. So what one should look forward to is with cut in the CRR, the cut in the repo rate, and improving liquidity, how the credit growth will shape up from here on. Because there are 2-3 elements which are in their favor. One is liquidity. Second is now the ECB. Actually, versus ECB, the domestic loans are actually much better, and that should give some kicker to the credit growth. And lastly, the retail credit growth may actually come back. So with this, I would actually look forward to that piece on an overall macro front, when and whether it is coming back and how soon it will come back with the festive season just few months away. So that is one part. On the exports front, there has been uncertainty because of tariff to these geopolitical situations. That overhang also is everyone is watching out for. In my opinion, if you look at IT, then in case of IT, that overhang need to come back, need to subside from here on. So that is the other place and where the valuations are reasonable. And thirdly, the other space where the valuations are reasonable is auto. So I'm just highlighting the spaces where the valuation compared to pre-COVID are reasonable, which is banking, there is lending, then there is auto, and then there is IT. So in these spaces, if there is some chance of growth to come back, then market should look forward to it.
Okay, IT and auto, these are some pockets you're looking at. Got that, Shreyas. Good to have you on. That was what I was coming to, just to understand the broad house view where you're looking to place new bets. We just had a discussion on IT, and I think it's still a debate out there because we're not getting the kind of growth numbers that the market would like to see. I mean, large cap companies are still giving you anemic growth, mid-single digits, not even seen high single digits in a while. And mid-cap companies, they're not all moving together as a basket. Some are up, some are struggling. Can you just expand on that point on IT? How do you find valuations, and why are you willing to look at it?
Valuations wise, definitely one comment I might have made earlier on this show that yes, this sector has, despite slowdown, this sector has not got derated. So the first decade of this century, the growth was 15% and the multiple was 20-25. Second decade, the growth was 10% and the multiple was 15 to 20. And now the growth is around 5% and the multiple is around 20-22. So with this, as far as valuations are concerned, on the PE basis, definitely the valuations are have not corrected commensurate to the growth slowdown. On the other hand, the cash flow profile of this sector has improved a lot compared to 2 decades ago, and that's where including the dividend and buyback that actually lends some support for the valuation, and especially in the context of every other sector which has got re-rated a lot. Now coming to the growth, so obviously without growth, nothing moves up in India. Just because whatever metric of valuation we can use, it may be free cash flow yield or it may be PE basis. So on the growth front, that's what my point was, that yes, with the global uncertainty. So the global uncertainty is leading to the indecision. And that indecision first started with the tariff uncertainty and now with the geopolitical issues. So on both these front, I think the tariffs and the negotiations are on, and probably we are at the fag end of it. So that is one. And secondly, on the geopolitical situations, if this subside further. So in this both these situations, if the sector, the growth for the sector improves, then there is a chance. Now, as you're rightly highlighting, the large versus mid and small. So the large cap, actually recently there was a result of Accenture as well. The large cap is seeing some pressure on overall growth for some time, and that's where the opportunities are to be found out at in the multiple sub segments of IT. It can be in the niche segments. The companies which are focusing on the niche segments in this, and some companies are there in the products as well, and some companies are there in engineering R&D. So it need not be the traditional way of investing, wherein the growth would depend more on the revival of the global outlook. But at the same time, there are pockets where there can be growth.
Hi, Shreyash. Good morning and good to see you, Ben. What about travel and tourism? You're quite bullish, I think, on the prospects out there. How do you play this theme, though? You have hotels, you have, the one listed, quality aviation stock. What's the view out there? How do you play this entire travel and tourism theme? Hotels, what else?
So in travel and tourism, there are multiple aspects. Definitely, see, this sector now is a discovered and established sector. So actually, so is most part of the market where there is a, so to say, structural growth in last 2-3 years. And those, this is hotel and basically tourism is one of them, like EMS services and manufacturing. So hotel tourism is one of them. This sector being already discovered, there are names obviously in the hotel space, they are in airline, or with airline there are not many options. Then you have certain companies which are derivatives. Some companies are there in the IT as well, who are focusing on the niche areas of tourism. There are players also in the luggage segment, but then their growth has been patchy. But then market should look into it when the growth comes back in that segment. So in all segments, actually, the what market is focusing on is the segment where there is a consolidation and there is a few winners, few clear-cut winners, which are emerging without much incremental competition. And that's what you are noticing, that market has flocked to those. While there are certain segments where there is a competition. Now, the luggage segment, there is a competition, newer brands are coming. And in that context, though the sector is doing well, the companies may not have done well the way you wanted. And that's where it's a combination of both sector tailwind and consolidation in the sector, and you being with the winner.
Okay, all right, got that point. Overall on earnings, Shreyas, I mean, that's the big hope for the market, right? That eventually we'll get a revival. FY25 was an aberration. What would you say? 10 to 12%, more than that, less than that? What do you expect on the earnings revival front?
Earning actually FY26 already, in my opinion, the earning cuts have happened because earning cuts were there for last 2 quarters now, 2 to 3 quarters since September quarter, especially it started big time. And with these earning cuts, which we have already seen, In my judgment, FY26 earnings probably may not see further cuts because all the issues which we market knows, which is the NIM impact on the banking sector, which is high weight and which actually drives the earning for the Nifty 50 or any large cap index. So in that context, most of this news and earning cut for FY26 is there out there in the market, and in my opinion, it may not get further cut. FY27, obviously, that earning scenario has to emerge from here on, and in that probability is there. Yes, you may see some earning cut on FY27, but FY26, I think it's probably there.
Okay. All right, got it. Shreyash, good talking to you this morning. Thank you very much for joining in and giving us perspective on the market. The market